Tesla is once again running into trouble in China. After a short rebound, deliveries from its Shanghai Gigafactory slipped in July, showing the US EV giant is struggling to keep its ground in an increasingly fierce market. Meanwhile, Tesla shares are climbing this Monday after a move set to make the world's richest man even richer. The company has awarded Elon Musk 96 million new shares, worth nearly $30 billion. By the end of July 2025, Tesla's delivery chart for electric passenger cars built at its Shanghai Lingang plant for China's domestic market had dropped to its slowest pace in 18 months. Orders, already shaky since early this year, slipped further mid-summer, leaving the 7-month total more than 40,000 units behind the same period in 2024. On paper, the 8.4% drop might look like a normal correction, but a closer look reveals 3 major drivers shaping the whole year: margin pressure from price cuts, the scale advantage of local competitors, and cost hurdles from raw material prices and regulations. These pressures feed into each other, forcing Tesla to rethink its balance sheet. Tesla truly ruled China's EV market in the second half of 2020, with sales rising steadily. But after the third quarter of 2024, that momentum slowed as BYD, SAIC-GM, and others launched aggressive discount campaigns. The Model Y and Model 3 from Shanghai held on to leadership in profit margins for a while, but constant discounts chipped away at gross profits. At the end of March, Tesla said it would stick to its cost reduction plan through scale. But after China's household EV incentives were updated with a domestic production quota, the expected benefits never fully arrived. By mid-April, Tesla cut factory prices by 4 to 5%. The base Model Y's price in some areas matched that of locally made dual-motor sedans. Demand only rose slightly, and the after-tax profit drop couldn't be offset, leading to a sharp delivery decline in summer. The second force behind this slump: local brands ramping up their scale. BYD, for example, is cutting costs on its Seagull and Song models through battery-to-chassis integration. Instead of enclosing battery cells in heavy metal casings, the pack is built directly into the chassis, saving 10 to 13 kilograms in steel and aluminum per vehicle and lowering costs. Tesla is testing similar structural battery designs in its Model Y 4680 version, but large-scale rollout isn't complete yet. In the meantime, BYD's domestic sales grew in double digits while Tesla's flatlined, with market share slipping from 16.5% in December 2024 to 13% in July 2025. The third wave of pressure came from raw materials. Lithium carbonate prices plunged at the end of 2023, and many analysts expected EV makers to enjoy lasting margin gains. But before the first quarter of 2025 was over, lithium prices rebounded. Nickel, manganese, and cobalt also hit cost thresholds again, affecting Tesla's long-range models still using NMC battery chemistry. The company plans to expand LFP battery production by year-end, but for now, cost savings in the first 7 months have been smaller than hoped. Currency moves didn't help either. The yuan's slide against the US dollar cut nominal revenue, even when shipment volumes held up. On top of that, mandatory environmental upgrades, like new low-emission cathode drying furnaces, pushed up capital spending. Tesla tried to balance China's slowdown by sending more cars to Europe, the Middle East, and Africa. But the EU's carbon border tax on Chinese-built cars reduced profit margins compared to German-made Model 3S and Model Ys. July data also shows a lasting shift in what Chinese buyers want: smaller, cheaper B-segment sedans and crossovers. Tesla doesn't have a model in this mass-market segment yet. An entry-level car is planned, but production won't start until 2026, delaying any market share comeback. Tesla's high-margin, low-volume strategy is still visible in its Shanghai export plan. In July, exports to Australia and South Korea leaned heavily on Chinese production. The factory is still running, but margins are falling. Energy costs are also rising under China's updated electricity pricing for high-consumption industries. Processes like metal pressing and cathode drying eat the most energy. Tesla's own solar park helps, but seasonal daylight swings affect output, adding cost pressure. The company's response has 2 main parts. First, shifting more production to LFP batteries to cut nickel and cobalt costs, while offsetting the heavier packs with lightweight alloys and recycled polymers. These steps lower costs, but, require more engineering investment. Second, boosting revenue from software subscriptions, such as making full self-driving a paid activation. But Chinese drivers aren't yet keen on expensive software, and early sales have been, well, underwhelming. Political and economic tensions make things harder. Trade friction raises risks to lithium supplies, and U.S.-China tariff rules mean Tesla can't sell U.S.-built cars in China or get U.S. subsidies for China-built cars, locking in extra costs for its dual production model. Local rivals, especially BYD and SAIC GM, keep prices low thanks to scale, while Tesla's margins suffer. Market share hasn't expanded as hoped, and investor caution is growing. Tesla's gross profit margin fell 377 basis points in the first quarter, then another 0.4 percentage points by July. Energy storage may help. Tesla's Megapack orders are growing, but vehicle revenue losses are too big to offset. The domestic sales target is 900,000 units, but current trends point to 820,000 to 830,000. Even with better results in other regions, the global delivery forecast might need to drop to 1.8 million. Competitors in China have mastered the scale plus profit equation. For Tesla, the Austin and Berlin factories will take time to reach full capacity, and major growth in North America won't happen until 2026. In the meantime, Tesla is looking at cost control tactics. Partial yuan-based supplier contracts, shared service centers with dealers, and bundling lower-value features into accessories instead of standard builds. These may help margins on paper, but won't solve the volume problem. Geopolitical risks add to the challenge. Every new tariff threat adds a sourcing cost premium. And in China, Tesla is increasingly seen as a foreign brand, competing with domestic champions, a perception BYD and SAIC GM are eager to reinforce. Bottom line, Shanghai's lines must regain momentum to recover 2025's profit losses. That means either reversing price cuts or slashing costs. Efficiency gains in LFP lines will be key, along with cutting energy and solvent costs. If not, China's sales decline will keep eating into Tesla's profits, forcing project delays and squeezing earnings per share. While Musk talks about AI, robotics, and massive energy projects, the reality in China brings Tesla back to the basics of car-making profit math. Keep market share through pricing, protect margins through cost cuts, and maintain R&D to invest in the future. All three need to succeed at once. Right now, Shanghai data suggests keeping that balance is harder than ever. If Tesla can't rebuild its profit-volume technology triangle, the negative signal from July 2025 could leave a permanent mark on the year's results. What's your take on this? Share your thoughts in the comments. And don't forget, subscribe and turn on notifications so you don't miss our next video. Thanks for watching.